The year was 1720. England, a nation on the cusp of modern financial innovation, was about to experience one of the most dramatic episodes in economic history. England found itself caught in the throes of an extraordinary frenzy. The air was thick with excitement and anticipation as people from all corners of society rushed to partake in what seemed like a golden opportunity. People from all walks of life, aristocrats, merchants, clergymen, even Isaac Newton himself, were swept away by the allure of quick riches. The feverish trading of stocks became a daily spectacle, with everyone eager to invest in the next big thing. The object of their desire? Shares in the South Sea Company. This company, with its grand promises and exotic allure, captivated the imagination of the public. This company, promising unimaginable wealth from trade with the exotic South Seas, became the epicenter of a speculative bubble that would ultimately burst, leaving behind a trail of financial ruin and shattered dreams. The promises of vast riches from distant lands seemed too good to be true, and indeed they were. This is the story of the South Sea Bubble, a cautionary tale of greed, speculation, and the dangers of financial euphoria. It is a narrative that has echoed through the centuries, reminding us of the perils of unchecked ambition and the fragility of financial systems. It serves as a stark reminder that what goes up must eventually come down, and that even the most promising ventures can turn sour. The South Sea Bubble is a vivid illustration of how quickly fortunes can change and how the pursuit of wealth can lead to devastating consequences. Understanding the events of this historical episode offers valuable lessons for investors and anyone seeking to navigate the complexities of financial markets. By studying the South Sea Bubble, we can learn about the importance of due diligence, skepticism, and the need to temper our expectations with a healthy dose of reality. The South Sea Bubble stands as a testament to the power of human psychology in shaping financial markets. It highlights how emotions such as greed and fear can drive market behavior, often leading to irrational decisions and catastrophic outcomes. It demonstrates how collective greed, fueled by rumors and speculation, can drive asset prices to unsustainable levels, creating a bubble destined to burst. The frenzy of buying and selling, driven by the hope of quick profits, can inflate prices far beyond their intrinsic value. By delving into the causes, events, and consequences of this financial disaster, we gain invaluable insights into the workings of markets and the importance of rational decision-making, even amidst widespread euphoria. The South Sea Bubble teaches us that while the allure of wealth can be powerful, it is essential to remain grounded and make informed decisions based on sound principles and thorough analysis. To understand the South Sea Bubble, we must first understand the South Sea Company itself. This company was not just another trading entity, it was a symbol of hope and ambition for the British Empire. Founded in 1711, the company was granted a monopoly by the British government to trade with South America, a region then under Spanish control. This monopoly was seen as a golden opportunity to tap into the wealth of the New World. This monopoly held immense promise, as the South Seas were believed to be teeming with gold, silver, and other riches. The allure of untold wealth captured the imagination of investors and the public alike. The company's formation was deeply intertwined with the political and economic landscape of the time. Key political figures saw the company as a means to bolster Britain's economic power and influence. Britain was embroiled in the War of the Spanish Succession, and its national debt had soared. The war had drained the nation's coffers, leaving the government in dire financial straits. The government, desperate for a solution, saw the South Sea Company as a way to both manage its debt and generate new revenue. The company was seen as a financial savior, capable of turning the tide of economic hardship. In exchange for the trading monopoly, the South Sea Company agreed to assume a portion of the national debt. This arrangement was formalized through a series of contracts and agreements, binding the company and the government in a mutual pact. This arrangement seemed beneficial for both parties. The government could alleviate its debt burden, while the company gained a privileged position in a potentially lucrative market. The promise of vast profits from South American trade was a powerful motivator. The government could reduce its debt burden while the company gained a privileged position in a potentially lucrative market. Investors were eager to buy shares, driven by the prospect of immense returns. However, this seemingly symbiotic relationship would soon prove to be a recipe for disaster. The initial optimism and speculative frenzy would give way to financial ruin as the true nature of the company's prospects became apparent. The South Sea bubble was about to burst, leaving a trail of economic devastation in its wake. The South Sea Company's early years were far from profitable. Despite the grand promises and ambitious plans, the company struggled to find its footing in the competitive world of international trade. The War of the Spanish Succession hampered its trading activities, creating a turbulent environment that made it difficult for the company to establish stable trade routes and secure profitable deals. Additionally, its access to South American markets remained limited. The Spanish colonies were heavily guarded and trade was tightly controlled, leaving little room for new entrants like the South Sea Company to make significant inroads. Despite these challenges, the company's directors, eager to boost its value, embarked on a series of aggressive marketing campaigns and lobbying efforts. They understood that perception could be as powerful as reality in the world of finance. They painted a rosy picture of the company's prospects, emphasizing the vast riches awaiting in the South Seas. Tales of untold wealth and exotic treasures captured the imagination of potential investors, creating a buzz around the company's future. They also cleverly exploited the government's need to manage its debt. The British government was under immense financial pressure, and the South Sea Company saw an opportunity to position itself as a solution to the nation's economic woes. They proposed taking on even larger portions of the national debt in exchange for further concessions, including increased trading privileges. This bold move was designed to intertwine the company's fortunes with those of the nation, making it indispensable to the government. These tactics proved remarkably effective. Investors, lured by the promise of high returns and the apparent backing of the government, flocked to buy shares in the company. The government, desperate to reduce its debt burden and seduced by the prospect of a flourishing trade with the South Seas, granted the South Sea Company increasingly favorable terms. These concessions further fueled the optimism surrounding the company's prospects. This, in turn, fueled speculation in the company's shares. The stock market became a frenzy of activity as investors scrambled to get a piece of the action, driving up the price of the company's stock to unprecedented levels. As the company's perceived value rose, so too did the price of its stock. The seeds of speculation had been sown, setting the stage for one of the most infamous financial bubbles in history. Section 4. The allure of riches, stock mania grips England. Word of the South Sea Company's supposed riches spread like wildfire. People from all walks of life, eager to share in the anticipated profits, began buying up its shares. The stock price, initially languishing at around £100 per share, began to climb steadily. As the price rose, so too did public excitement. The allure of quick and easy wealth proved irresistible. Coffee houses buzzed with talk of the South Sea Company and its incredible prospects. Fortunes were supposedly being made overnight, and no one wanted to be left out. This speculative frenzy was further fueled by the company's directors, who engaged in various tactics to inflate the stock price. They spread rumors, issued glowing reports, and even bribed journalists to write favorable articles. They also made it easy for people to buy shares, offering generous credit terms and accepting various assets, including land, as payment. Section 5. Ascending to unrealistic heights, the bubble at its peak. By the summer of 1720, the South Sea bubble had reached its peak. The company's stock price soared to over £1,000 per share, a tenfold increase from its initial value. The company, despite having limited actual trade and minimal profits, had attained an astronomical valuation. The mania surrounding the South Sea Company had gripped the entire nation. People were selling their homes, mortgaging their possessions, and even borrowing heavily to invest in its shares. The dream of becoming rich overnight seemed within reach, and few dared to question the sustainability of the boom. However, beneath the surface of this apparent prosperity lurked a dangerous truth. The South Sea Company's valuation bore no relation to its actual earnings or assets. It was a bubble inflated by speculation and fueled by greed, and like all bubbles, it was destined to burst.